By the end of the 1970s, the United States was in a prolonged period of stagflation. Inflation had settled into double digits, climbing to around 14% in some months of the year. Oil shocks, the wage price spiral, and flexibility in monetary policy had left inflation expectations unanchored. In this context, in August 1979, Paul Volcker became the head of the Federal Reserve. The tightening measures to be implemented shortly thereafter would be known in economic literature as the Volcker Shock. When Volcker took office, the situation was clear. Price stability had been lost, expectations were disrupted, and classic interest rate adjustments were insufficient. Volcker set aside the traditional approach of guiding interest rates with small steps and moved to a stricter framework targeting the money supply. Control over bank reserves was tightened, and the federal funds rate was allowed to fluctuate freely within a wider band. The aim was not to avoid the market's volatile reaction, but to ensure that this tightness was felt, thereby re-anchoring inflation expectations. The initial effects were severe. The federal funds rate was around 11% in 1979, and by the middle of 1980, it approached 20% and occasionally exceeded this level. Interest rates on home loans reached 18%. With the contraction of credit channels, investments slowed down and access to financing became difficult. After a brief pause, the economy experienced a two-stage contraction. A short recession in 1980 followed by a deeper downturn. The unemployment rate rose above 10%. Later in the year, it reached 10.8%. This was one of the harshest employment shocks since the Second World War. As social and political pressure increased, Volcker's policies faced intense criticism. Sectors with high interest sensitivity, such as construction and manufacturing, were heavily damaged. A wide range of people, from contractors to farmers, raised their voices. Criticisms in Congress intensified, and calls for resignation were made. Despite this, Volcker did not back down from the view that lasting prosperity would not be possible without price stability. By maintaining policy consistency and communication, he continued to convey the message that inflation would first be broken. By 1983, the fruits of the approach became visible. Inflation permanently fell to single digits. It was stuck in the 3 to 4% range. As expectations were anchored again, the credibility of monetary policy strengthened significantly. As financial conditions balanced, growth returned, and the foundations for a more stable expansion phase, which would continue for the next decade, were laid. For many countries, central bank independence and the goal of price stability became the main axis of the policy framework. The impact of the Volcker shock extended beyond the borders of the United States. High American interest rates and a strong dollar put pressure on developing countries with external debt denominated in dollars. Interest costs rose, in the Stasos, capital outflows accelerated, and a debt crisis was triggered, especially in Latin America. The region entered a challenging adjustment process known as the lost decade. This was a striking example of how tight monetary policy could produce side effects through the global financial architecture. The balance between short and long term is the most lasting lesson of the Volcker era. In the short term, unemployment rose, production fell, and asset prices were pressured. In contrast, in the long term, inflation expectations were re-anchored, policy credibility increased, and growth continued with lower volatility. This framework also laid the groundwork for the relatively calm macro environment known as the Great Moderation, spanning from the 1990s to the early 2000s. Of course, the Renaissance situation the criticism that this calmness encouraged other vulnerabilities and over time created room for the accumulation of financial leverage is a separate topic of discussion. However, Volcker's goal was to restore price stability and re-establish control over monetary policy. Looking back today, Volcker's legacy can be summarized in 3 points. First, price stability is a prerequisite for sustainable growth, and when expectations deteriorate, a decisive policy response is necessary. Second, central bank independence is the fundamental assurance of maintaining consistency even in difficult times. Thirdly, the distributional costs of tightening are real. Therefore, fiscal policy, coordination with labor market measures and financial stability tools is critically important. A well-designed policy mix shortens the path to the goal while sharing the cost fairly. As a result, the Volcker shock should be seen as a historical example of a painful but lasting remedy. In the short term, high costs were paid, but in the long term, price stability and policy credibility were regained. This experience reminds us of the importance of long-term thinking, sticking to a clear goal, and progressing with a consistent framework even when popular pressures increase. Volcker's approach shows that fighting inflation is not just about interest rates, but relies on a broad policy design that anchors expectation and decisive communication. Therefore, the Volcker shock remains a turning point in the history of economic policy. You can follow for more content.